Good afternoon and welcome to the HEADLAM Group PLC half results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Chris Payne. Good afternoon to you.
Hi there, thanks for joining the presentation for the half year. So if we just turn the page, Adam, there's just a short introduction before I hand over to Adam, who's going to kick us off. So the four main sections to the presentation. Given we're already in October, the first half seems a little while ago, so we'll probably canter through that section. But what you'll see is this sort of, I suppose the market conditions remain pretty challenging, which has affected our first half, but Adam will talk us through that. What you will see is that we've managed to navigate cash and working capital in a well-controlled manner. And I'll give a little bit more of a detailed update on how our strategic initiatives are rolling out, together with this acceleration by way of a transformation plan that we've announced. So I'll spend a little bit more time on providing an update on those elements. So I'll just ask Adam to sort of update us really on the first half performance and that backdrop of the market context that I mentioned at the start.
Thanks, Chris. Yeah, I'll start with a couple of slides on the market just to give you the kind of context for how the market's been in the first half, and as we look out over the second half and into next year, and then I'll cover off just in a handful of slides the half one financial results. So just looking at the market and particularly the market in recent months and over the first half of this year, and if you look at the top half of this slide, this sets out a few of the key market indicators that we track and that are relevant for the flooring market. And you can see on the top left-hand side there, you've got consumer confidence, and in particular the orange line, which is the major purchase index. And you can see that's been quite firmly negative throughout the last kind of 18 months or so that we've shown on this chart, and particularly with the orange line, the major purchase index, lagging the overall consumer confidence. And since we've published these slides, actually we've now got the September consumer confidence data, which has actually shown a considerable lurch down actually in September on both that orange and that blue line, potentially on sort of pre-budget fears at the end of October. We'll see over the next couple of months as to how that consumer confidence index tracks. In the middle of the slide there, so housing transactions, so an important indicator for the flooring market, because once you've got someone who moves house, typically maybe 6 months or so later, that's when you might see some home improvement spend on kitchens, bathrooms, flooring, etc. And we've seen, on this chart, 4 consecutive months now of those being in growth. We're now in the 5th. It's now been 5 months in a row that we've seen growth. But that has come off the back of a very negative period. So 20% decline in housing transactions in 2023 and an 8% decline in Q1 this year. So we won't see the benefit of that until maybe back end of this year or perhaps more likely into next year. And then on the right-hand side, this is the Barclays data on consumer spending on home improvements, which you can get from their website. And as you can see, that was firmly negative through 2023. And so far in 2024 has shown no sign of improvement yet in terms of what consumers are spending on home improvements. And what that means for the flooring market in the first half of this year is that we estimate that has declined 10 to 15% in the first half of this year. And cumulatively is now a 25% plus decline in volume terms since 2019. So a challenging backdrop for the market, but the lead indicators are more positive. With paying growth, consumer confidence, whilst it's lurched down in September, has been on an improving trend. Interest rates reducing, housing transactions in growth. So we do expect the flooring market to return to growth at some point during 2025. But the timing remains uncertain. So if I just turn then to HEADLAM's specific performance in the first half of the year, and on this table here we show the revenue performance by channel, and we've broken out the UK into a bit of detail. And you can see there we've continued to deliver good growth in the strategic initiatives of larger customers and trade counters, and they were up 2% and 7% respectively. Regional distribution at the third row in that table there was most impacted by the weak residential market, and that was down 18.8% in the first half, but has been on an improving trend in more recent months. And then in continental Europe, so we operate in France and the Netherlands. The market conditions there have been more severe than in the UK, and revenue declined 15.9% in the first half of this year. So just looking at those three main UK channels in a little bit more detail. I won't go through all of this, but on this slide, and this is on our website, we've laid out some of the operational developments in the first half of this year. But we made it on the left-hand side of regional distribution some service enhancements in the first half of the year in terms of customers being able to track their deliveries online in real time. We've done a bit of network optimization, so we've consolidated sites in the northwest of England, which has been successful. And then towards the end of the period, we've launched some new value ranges, which were well received in the market, as well as increasing our own product brand mix. And you can see in the bottom left-hand side there, we've seen an improving trend in recent months. While still in decline, but we've seen a lessening in the scale of decline in the regional distribution market. Our regional distribution sales, despite the market not showing any signs of improvement yet. So moving to the middle there to trade counters. So 7% revenue growth in the first half, now annualizing over 100 million of revenue. And we took the site count to 76 at the end of the first half. So that was 9 new and then 11 refurbished. And you can see the chart in the middle there just shows the portfolio of trade counters we've got. So 76 in total, of which 67 now are in the new format, so refurbished. And collectively, those trade counter sites are all performing in line with the business case, and that's despite the weak market. Right-hand side, larger customers, tough period for multiple retailers due to the weak end consumer demand. And indeed, we've seen multiple retailers exit flooring in recent weeks, Carpetright and SCS. SCS is just a strategic decision to get out of flooring, but Carpetright entered administration. And collectively, that's about £250 million of flooring retail revenue, which now will dissipate elsewhere in the market and across other retailers, which provides an opportunity for Headlam. We weren't a supplier of any scale at all to Carpetright, so there's an opportunity there as those sales move elsewhere in the market. And then finally, we've had 2 new customer wins in the first half of the year. One that was launched in Q2, which was distribution as a service to a manufacturer, and one that's launching around now, which is a new multiple retailer customer. Income statement, I'll actually cover this through the profit bridge here. It's probably a neater kind of illustration of it. So this shows the year-on-year movement in our operating profit from an 8 million profit in the first half of last year to the 13 million loss in the first half of this year. Volume, as it was in 2023, with volume, it was by far the single biggest driver of that reduction in profit, and that reflected the weak residential market. The next bar along is gross profit, and gross profit percent dropped 86 basis points year on year, and that's predominantly due to increased clearance activity, particularly towards the end of the first half. And the other point of note here is that there's actually been, for the second year in a row, very limited price inflation in the market. So what would normally happen is normally see manufacturers putting price through into distributors, which would go on to the end consumer. There's been very little of that in the past 2 years, as manufacturers have sought to protect their own volumes in a particularly weak market. Just moving along the bars here, strategic investments. So there's about 1.5 million profit impact from this, and this is predominantly trade counters. So trade counters, as we roll them out, they are profit dilutive in the rollout investment phase, but then profit accretive as those trade counters mature. And we're obviously in the rollout phase at the moment, so we've seen a little bit more profit dilution, and that will flip into accretion as we get into maturity, kind of 2026 onwards. Cost inflation, 3.3 million headwind, principally driven by people costs. and that included the 10% increase in the national minimum wage in the UK, which came through early this year. And then finally, the final two bars, so market weakness in continental Europe reduced profit by 1.4 million. And then there's a further 3.4 million impact from other items, including non-repeat of one-off benefits in 2023, like insurance settlement, etc. And then there's the green bar there, 1.5 million of mitigating actions offsetting some of those headwinds. Non-underlying, I won't go through this in any detail, but we've laid out the detail here on non-underlying items. So these are the bits that are stripped out of our underlying profit numbers that we report. The two biggies are the third and fourth row, where we've got the business restructuring and change related costs. So this links to the transformation plan, which Chris will talk more about later. And most of that 4.9 million of P&L expenses is non-cash impact of stock write-downs. And then the fourth row is the profit on the sale of property, which is the Stockport disposal, which happened in the first half of the year. So that was a 7.4 million cash inflow and generated a profit of 3.2 million. So just moving on to cash flow, good operating cash generation. So if you look at about a third of the way down that table on the left-hand side, operating cash flow of 18 million. So despite the impact of the market on the P&L, broadly flat year-on-year operating cash flow, and that was underpinned by working capital inflows, which was a combination of in part due to lower revenue, which has then generated lower receivables, but also tight control of inventories, which were down 6.5 million in the first half, but actually down 23 million year on year. And if we move further down the cash flow, capital investment was 6.7 million in total, which is principally trade counters, and then the final element of the solar panel investment program, which ended in Q1 this year. There's then 4.8 million of dividend payments, when that was in respect of the 2023 final ordinary dividend, which we paid in June this year. And then we had a 7.4 million cash inflow from disposal of Stockport in June this year. And all of that, if you look at the very bottom row, all of that meant a slight reduction in net debt of just over 1 million in the first half of this year. And that's illustrated on this chart here, which is just a waterfall that shows the net debt at the start of the year through to where it was at the end of the first half of the year. The green bars show reduction in net debt, so that's kind of cash inflows. The grey bars are the outflows, and you can see the outflows on leases, capex, and dividends were offset by working capital and the property proceeds, so resulting in net debt broadly being held flat throughout the first half of this year. Balance sheet. So just before I wrap up overall, just a note on balance sheet, and HEADLAM continues to have a strong balance sheet, and that's underpinned by property portfolio, which is valued at 142 million pounds, the last valuation, which was January 2023. Significant liquidity headroom. So at the end of June, 72 million of cash and undrawn banking facilities available to the group. And ongoing support from the bank syndicate, including a revised covenant package to give us the flexibility as we implement the transformation plan, which Chris will talk about in a minute. And the final point on here is with this further balance sheet strengthening in the period, which was provided by the pension buy-in transaction, which we completed in March this year. And what that does is it removes exposure of the group to volatility and pension assumptions. And it also means that we remove the ongoing contributions into the scheme, which had been about £1 million per year. So just to wrap up then, challenging market conditions, 10 to 15% decline we've seen in the market in the first half of the year. And that has weighed on HEADLAM's performance, and we've seen 11% revenue decline in the UK and 12% for the group in the first half of the year. But the strategic growth areas have performed well. So trade counters up 7%, larger customers up 2%, and cash or working capital well controlled. Stock down 6.5 million in the first half and 23 million year on year, and net debt broadly held flat in the first half compared to the end of 2023. And as just covered on the previous slide, strong balance sheet, so 72 million of cash and undrawn facilities available to the group at the end of June, and 142 million pounds of property assets. I'll hand you back to Chris now to talk through update and transformation plan.
Thanks, Adam. Right, so we've got a couple of slides here just as somewhat of a reminder over the strategy and how we've been progressing so far before we turn into a little bit more detail to cover the transformation plan. So the first slide is just a heads up on the kind of customer and how we view the market scaling. So a little while ago, we articulated the size and scale of the market. Now, given the recent weakness in the market that as just referred to, this market might be slightly smaller than 3 billion, but broadly that's the number we've been referencing. And then we've identified these 7 customer types. And this is really the underpin and the fundamentals behind our strategy. So the group has been very traditionally strong in the left-hand side of these customer segments, the retailers and the independent tradespeople, and less strong and less representative of the market purchases as you move to the right. So the larger contractors and the pure play online customers typically would go direct to manufacturers for their purchases. So Headlam's exposure and opportunity in these different customer types are different, and therefore for our kind of thoughts around growth and where we could see additional sales coming from, certainly we need to develop our propositions for these customer types towards the right hand of the page. So very much product is the focus behind how we've addressed the market in recent times on the left hand side, and moving more to a solution and proposition related sales approach for the right hand side of the page. So that was the underpin to our strategy. And then if we sort of expressed our strategy in these sort of 5 pillars. So the 5 pillars, how are we going to achieve the sort of the vision of being the leading experts in flooring? 5 pillars. The one on the left hand side is around our great service. So we remain the sort of market leader from a service perspective, and that's according to our customers. So we survey our customers every year, and they always tell us that we are the great service. So do not lose your service position in the market. So that's what we've been known for. That's what we're great at. But the second pillar over is about developing new areas. So I talked about the new customer types that we've been focusing on. So remain strong, remain market leading in service, but look at perhaps offering that proposition and service to new customer areas. The middle pillar here is around operational capability, and I've got an example in a moment where we're looking at sharpening that up. That's particularly challenging in a declining market, because you're trying to keep pace with a sort of falling demand curve. So you've got to be operationally efficient just to stand still, and that can be tough when you've got a sort of nationwide infrastructure to work with. So we've been focusing on how to be more effective over time, and that remains a key part of our strategy going forward. And on the right hand side, we cover this less in these slides, but we've recently made a number of announcements on our sustainability. We released a sustainability report and strategy as part of our year-end update, and we've done a number of initiatives that focus on that, and I'll cover those in a moment. And making Headlam a great place to work is all about investing in communities, investing in our teams, training, development, safety, having that kind of inclusive culture, I suppose, of working at Headlam, and that we've made great strides in that in the last couple of years. So just some specific examples of where we've been delivering against these 5 strategic pillars. Again, I won't go through all of these. You may have seen these in the slides and they're there to look at, but we have been launching new products to address, particularly where price points are increasingly important in the market at the moment. We've launched some well-priced, good quality brands such as Every Room in the marketplace. We've been exploring the digital investment of the business and trying to offer digital assets to our customers, and we've seen a significant increase in the revenue that's flowing through our digital channel. I talked about going into new areas of customer engagement. We've seen our trade counts footprint increase significantly, as Adam described earlier, up to 76, and that's in its investment phase at the moment, where we are seeing some revenue coming in, but obviously the costs typically are front loaded where you're opening new sites and investing in new people to run those trade counters. It's an investment for the future. Now that is running at a higher annualized run rate, but as I said, you have to invest before you get the maturity of those new trade counters. Despite that weak market, we've still seen larger customers increasing their trading, and that's been despite the challenging market where we've seen people like SES come out of the market, Adam mentioned earlier, and the footfall challenges of a declining market have affected the multiple retailers and our large customers in the same way. So people like B&Q, Homebase and other customers have also seen challenges of footfall and demand reductions over a challenging period. Operational capability, I'll come on to an example of that in a minute. Transport integration is something we've been working on for a good period of time, and that's coming to an end now, where we've got a national transport service moving away from those regional services that we used to operate. And the final piece of that was, and I've referred to this before, of sort of almost like a parcel mentality. So as a consumer, you get used to tracking your parcels in real time on an app. We now offer that kind of service to our customers who can track their deliveries by looking at our delivery tracker, so that they get sent an email, for example, which they can click on and shows where their deliveries are. So we've been doing a lot around our service offer for deliveries, not just around kind of cost reductions. I mentioned sustainability on the right hand side. Now we have installed solar panels. We're looking at decarbonising our fleet. We've nearly fully rolled out low emission vehicles for our non-HGV fleet. As I said, we've reduced electricity load by putting solar panels on, and this is something that's a long-term plan for us to go carbon neutral in the next decade or so. And then the take back scheme is an interesting one, where we've been looking at how do we take carpet in particular out of landfill, and we're looking at offering that as a service to customers who can bring their removed product back to one of our trade counters for reprocessing, and that's been a successful trial so far. We've saved about 35 tonnes from landfill, and we're looking at how do we potentially roll that out to other sites. Customers like it because it gives them the ability to get rid of a product. They know they'd rather not take that for waste, and interestingly, they actually purchase some more goods when they're visiting us at our trade counter. So it's got some merits as well as just the sustainability merits as well. And on the right hand side, I've mentioned a number of training and initiatives we've been developing, both in terms of investing in our people and safety processes, but also the one on the bottom right is an interesting one, where we have an apprenticeship scheme in place, where we support fitters becoming trained in the industry, and they do a rotation around a number of our suppliers who are effectively partnering with us to give an opportunity for people to learn flooring fitting and getting into the industry. I think that's part of the future and the investment we're making as an industry. So a couple of deep dives on some of the examples. How do we know that we can do this well? So on the next slide, we've picked out a couple of examples. So I'll come onto the transformation plan in a minute, but we know we can do some of these things. So transport integration, I've given you an update on that already. That's something which we've developed over the last few years, which has taken a regionally fragmented delivery network and turned it into a national network. So we now can deliver anywhere in the country across all of our postcodes, and we no longer send vehicles in opposite directions with the same product on it. So customers now get single deliveries as well. So it's an integrated model. It's reduced mileage, reduced the carbon, reduced our number of trucks and drivers, and maintained a national delivery network. So we've had great success with that. Consolidation of sites is something else that we've been looking at. So again, the sort of network has been one of regional distribution centres through acquisition, and now we've moved much more to a national service and national offer. It gives us an opportunity to look at our network and perhaps leverage some of our national sites in a more comprehensive way, and move more to a cross-dock structure around the east and west sides of the country. So we announced the closure of Stockport. As Adam mentioned, we've had the cash in, and this is something that we can now do. We can leverage our other assets and still maintain that great service by using a different cross-dock facility. So that's something that we've had success in, and there's more to come. So we've got our existing strategy, which I've just outlined, and we've now talked about this sort of acceleration, really. So this is not a new strategy. This is really a maturity of some of those pillars that I've just talked to. So putting the customer first. So I've talked about the customers underpinning our strategy, and that's something that we're looking to accelerate. The network that I just referred to, where we're looking at sort of more of a national network and simplifying it. Again, there's more that we can do there. And as a result of those two things, moving to a much more simplified, cohesive structure, it means that we can finally improve the way that we act as a business as well. So simplifying, consolidating, and applying ourselves as one business rather than multiple businesses operating under a kind of common ownership structure. So a much simpler operational process as well. So what does that mean? So if I just take the first one, simplifying our customer offer, the brands on the left-hand side are our wholesale brands that we've been using for many years as a result of acquisition. But the consequence of the customer is quite complicated, and you end up with many of those brands potentially competing, but at least presenting a different face to the customer. So customers will have multiple accounts with us. In fact, they would need to have multiple accounts with us in order to get the best out of our product set. And we're looking to consolidate all of those 32 brands on the left-hand side into a single operating business, a single wholesaler, which is called Mercado. And we spent a bit of time deciding whether to dream up a new name or use HEADLAM, but in the end we chose Mercado because it's an existing business, and more than half of our customers actually have a Mercado account already. So it was an obvious choice for us to move to. So what does that actually mean then, I suppose, for the customer? So what does this mean? So our sales teams will be operating as a single business nationally. Now that means that they will have a much smaller patch, and we focus them around a sort of geographic area, rather than them having to spend time in their cars driving across the country seeing customers from out of their patch, if you like. We've reprofiled the national sales team so that they focus on a tight territory close to where they live. And just as an example, they'll typically move from supporting on average 6 postcodes to more like 2. So much less time driving, much more opportunity to spend time with their customers. Our single business will have access to the full HEADLAM range of products. I mentioned earlier that many of our customers would need multiple customer accounts to get access to the HEADLAM range of products. And now we can offer that under a single product list available for all customers. And similarly, geography, we can finally unlock the benefit of a national network. So if you're ordering from a business in the north of England, and you might wish to collect it because you've got a job in the south of England, you can do that now. And that's not been possible until recently. So again, order anywhere, collect anywhere, and enhancement for customers. This sort of national approach also means that we have enough density to offer a sort of separation of expertise between our residential products and residential customers and our contract and commercial customers. So salespeople were really able to align themselves with their customers and the business that they're supporting. The point of sale material, again, imagine you've got 32 businesses there, potentially all with different point of sale material, and also potentially trying to compete for the same shop floor space in customers' premises. So again, it means that we can invest in common point of sale, common voice with customer, and better quality as a result. The other implication of this is that as a result of having all of these businesses, when you do try and invest in those digital assets, and I refer to a significant increase in the amount of sales coming through a digital channel, every time you make an investment and every time you make a change to the digital offer, you have to replicate that across all of those different B2B websites. So it means now we can have a single B2B website supporting all of those wholesale brands, and it means we can invest in depth with good quality without repetition. So a much better service for customers. So a whole number of customer benefits there that also simplifies our business. So that's sort of a summary of where we've got to. We've announced this. We've now started embedding those businesses into the network. We've had the conversations with customers. and many of those things are already in place, and we're going through a process of converting those customers into that new account at the moment. Point of sale, and I talked about that those new stands will take a little time to come, so those in the next few months. And then the B2B website, again, we have now got open, and we're in the process of migrating customers to it. So this is something that we're going to now have the ability to manage in a smaller number of places, and this is something that we can now start to review in a much more agile way, rather than splitting and spreading our energy over so many sites. Interestingly, I put this slide in here, and you may have heard me talk about this before. Some of the questions that have come from shareholders and also from chatter, I suppose, in the marketplace is that HEADLAM has perhaps not had so much experience in the sales team with competitors, people like Likewise opening up and others. You know, have we actually got the experience in our sales teams to engage with customers? And I thought I just put a slide up which shows the scale and size and experience in our teams, and there's a huge amount of expertise and knowledge of the industry in our business, and I thought it'd just be worth showing how we're structured. So I talk about a residential and commercial side of our wholesale business, and this is the structure that we operate through. So we've got, you know, managing director of each of the businesses, we've got regional sales directors around the country, all then underpinned with area sales managers who are fronting into customers. So a huge amount of experience nationwide across the whole country. So the second section is the sort of simplification of our network, really. And I mentioned having a number of distribution centres that's largely been inherited through acquisition. And there's an opportunity for us, therefore, to simplify our network. And that might be a much more capital efficient programme, and indeed offer a more nationwide footprint. You know, we've got dots on this map here which are much more regionally focused than you might imagine, and we've made some announcements already, which is logically moving some of these distribution centres into more a central location, removing duplication, and where we are moving some of those distribution centres, using cross-stock capability to access the customers. So again, now we've got a national offer from a sales perspective, a national offer from a transport perspective. The next logical step is to look at a national network as well. So opportunity for us to accelerate the changes we'd already started. So timing wise, we've got a number of these phases already completed. So on the left hand side of the page, we talked about this site in Stockport, which has now been replaced with a cross-dock facility, which is a sort of the blueprint that we follow when we do that. And we sold that particular site and returned some capital. We've now announced a number of changes as well. So we're opening a new facility which is much closer to the London and South East marketplace for our customer service to be offered into. So in Rayleigh and Essex, that means the Ipswich distribution centre that was servicing that part of the country will therefore become much more of a cross-dock location. So we can move and shift our distribution service much closer to London, and it saves significant journey time from there. We have two sites in Glasgow, and again, duplication of effort, an opportunity to operate from a single site, and those properties are now on the market. And this is something that we'll continue to keep under review, and there will always be opportunities for us to look at our footprint and look at how do we offer this sort of operationally effective nationwide service going forward. So the third element of our change that we've referred to is really as a result of offering this sort of simpler customer offer with 32, what was effectively 32 businesses into one, and this sort of simplified network. It means that all of the support processes that go into supporting that arrangement can be simplified. And what do I mean by that? So it means that we can offer, instead of having 32 accounts receivables, for example, we only have one because we're billing our customers from one. Where we're deciding what stock to hold and where, we now have access to a nationwide geographic stock list, and it means we can pick now where our stock is held around the country rather than very localized decision making. So this sort of centralization of buying, stock holding, as well as supporting the individual businesses is now possible. So it gives us the opportunity, therefore, to simplify and reduce cost to support those businesses. Adam, it might be worth you picking up the next couple of slides, because I think this now starts to talk about the value and the benefits and the financial benefits of these changes that we've articulated.
Yeah, sure. So on this slide here, you can see we've set out the 3 kind of overall key objectives from this 2-year transformation plan. So those are market share gains in our core distribution business through the sales transformation, unlocking capital to delever and to fund the transformation, and then also to structurally improve profitability. And on this slide, and I won't go through it, but we've laid out, you can see in the orange and the turquoise kind of coloured bars or columns, we've laid out the actions over the next 12 months. This is a 2-year program, but the ones that particularly that we're focusing on over the next 12 months, we've laid out here, and we will update on progress as we work through these, with a number of these well progressed already. So in terms of the overall benefits from the 2-year program, moving left to right, so we're targeting 70 million plus of one-off cash inflow, and that's from disposal of surplus property and working capital optimization, so specifically stock reduction. And we expect to generate that 70 million within 2 years, so kind of by September 2026. And then at least 15 million pounds of annual profit improvement. And it's important to note this is net of reinvestment in enhancing our customer proposition. So there's quite a number of areas of reinvestment where we've chosen to reinvest some savings to enhance the customer proposition. That could be, for example, shrinking the territories that our sales team are doing. So rather than covering 6 postal areas, they're covering 2, so they can spend more time with customers. And that net profit improvement comprises, it's a hybrid. It's not just cost, it comprises revenue, margin improvements and cost efficiencies, recognizing that some of the gross cost savings we're making are being reinvested. And we expect to start making those benefits in 2025 and achieve the 15 million pounds as a run rate at the end of the 2 years. And then on the right hand side, 25 million of one-off cash costs. So this again, pretty evenly spread really over the 2 years, but it's over the next 2 years. And this is from things like restructuring and relocation costs. So the cost of moving the Ipswich operation into Rayleigh, which is ongoing at the moment, fitting out new sites, advisory consultancy costs, and then investment in point of sale materials such as display stands, which Chris mentioned earlier. So overall, 2-year program, 70 million plus of cash, 15 million plus of annual profit improvement.
Okay, thanks, Adam. So just a couple of slides to bring us to conclusion before we look at questions. So I've sort of split the outlook into 2 really. One is around the short term and one is a slightly longer term. And short term, no surprise here that we're being relatively cautious, I think, about the outlook in the short term. Adam mentioned at the start that some of the macro indicators have been weak, maybe slightly improving, and then of course consumer confidence has taken a little turn for the worse in September. So we remain pretty cautious around what the short-term outlook might show, and there are differing views over the speed of recovery. When will the market come back to normality? When will the sort of the decline in flooring demand in particular recover? It's difficult to say, but we do think that perhaps we've seen the worst of it, but it's difficult to know when that outlook is going to improve. So we are being cautious about 25, and we do expect perhaps the market might return to growth at some point in the year, but it's difficult to know when. So I think it gives us an opportunity for us to make these changes, implement the changes that we've outlined, and get ourselves ready for that recovery when it does come. So when you look at the medium term and the longer term outlook on the next slide, what we can see is that we've seen some growth coming through our existing initiatives to broaden the business out into these other customer types. When you overlay the transformation plan, which is going to accelerate some of those benefits that we've talked to, and in particular then when the market recovery does come, you can see a much stronger business emerging, a much more efficient, a much more capital, a leaner capital structure behind our business. So it does give you much more confidence for the future, particularly when that market recovery does come in. So that's the end of that. And just to summarise then, I think, as I said at the start, this short-term challenging market remains in place and is likely to be there for a little while longer and perhaps start to improve next year. In the meantime, we've been keeping a lid over our working capital. We've been staying close to cash and keeping our business and balance sheet in good order. And we're starting to see those strategic initiatives delivering, which can only now be accelerated with some of the changes we've announced. So look, short term, I think it does remain a difficult position, but I say much more confidence around the medium term. So thank you for listening in on the presentation. And now we've got some questions that I think some of you have already submitted. So we'll start to look at those now and answer those.
Perfect, Chris. Adam, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Chris, Adam, as you can see, we have received a number of questions throughout today's presentation. And if I may now hand back to you and kindly ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you both at the end. Thank you.
Okay, thank you. So first question I've got, Adam's partly answered. It says, please comment on whether competitors are exiting the market. So Adam mentioned earlier, we've had a couple of businesses go into administration and somebody else withdraw from the market. So Carpetright and the Floor Rooms, and it's one of the companies owned by the same owner, have gone into administration and they're direct-to-consumer businesses. So they've come out of the market. SES withdrawn from flooring. In the B2B environment, we've also seen two other businesses go into administration who are not flooring specialists, but do in fact sell flooring. So CTD, the tile business, and IDS, who are also a services business that happen to sell flooring. So there's been a fair bit of distress, I think, in the sector, and as Adam described, I think it will allow more sales to move into other parts of the market. So that demand will be satisfied elsewhere. We are well placed to pick up and support our customers who are benefiting from the direct-to-consumer sales coming into the market. And then in the B2B space, no doubt there will be a little bit of an overflow as well. So that sort of thing is helpful in both the direct-to-consumer and the B2B non-flooring specialists. We haven't seen anyone else exit the market who are flooring specialists in the B2B market. Adam, perhaps the next one's for you.
Yeah, sure. So next question is about return on investment on the trade counter investments we're making. So let me answer that as a collective of trade counters overall to start with, and then I'll give you the unit economics of a single site just to bring that to life for you. So overall trade counters then, so when we started this program, we had about 50 sites in 2021, end of 2021, generating about 85 million of revenue. And we're targeting about 100 sites, doing about 200 million of revenue upon maturity. So it takes a number of years, takes 5 years or so for each site to reach maturity, but on maturity, 100 sites, 200 million of revenue. But we expect that to generate about 10 million incremental profit compared to where we started. And the cost of that, from a CapEx point of view, is up to about 25 million. I think we originally guided 25, it might come in a bit below that. So you've got about 25 million of investment generating 10 million recurring profit stream. Now in the short term, you do get some profit dilution. So compared to 2021, where we are now, because what happens on let me give you the example of a single site. So a single site, when you open that, it will be loss making for its first 15 months or so, and then becomes break even, and then starts generating a return on investment that exceeds our cost of capital once you get to kind of year 3 or so. And on a 5-year average basis, you'd expect a new trade counter to generate a good double-digit return on investment over the average on a 5 years basis.
Okay, thank you. Next question is, it says, prior to the current downturn in the market, you had an expectation of achieving a net profit margin of 7.5%. Given the change in your route to market, more focus on large customers and trade counters and less on retail distribution, what's your current expectation on target net profit margin? And there's a second question then that's very similar, which says, if the market returns to growth in 25 and normalizes in 26, when do you expect a return to sort of optimum net margins? So if I combine those two, there's a couple of ways of answering that. I think firstly, Adam has mentioned there that the maturity profile for things like trade counters, we don't expect the operating margins of a mature trade counter to be dilutive. Now, what is true to say is that when you get the marginal sales from a wholesale or retail distribution model, they are rich, and because you're leveraging your existing cost base. So by removing those sales, by losing that kind of market demand, you end up with a lower set of margins. But the key accounts, the larger customers and the trade counters themselves should still have margins which are in line or exceed the historic margins the group has come to. So there's nothing inherently dilutive about us growing into those other areas of the market. But what it does need, therefore, is a recovery of our regional business, the one that leverages the investment and the cost base that we have as a group, in order for us to see a return to the higher margins that we've seen in the past. So again, we've lost perhaps 25% of that margin, if that market is gone. So we've not necessarily assumed that we're going to get that back in the short term. And therefore, it's difficult to answer when that margin might come back. Now, if all of that comes back, then we can see us getting back up to the mid to high single-digit margins. Some of the analysts have sort of speculated as to whether that might be, and they've sort of got us in at well above 6% in the sort of next few years, just assuming the maturity of the trade counters, the maturity of the key accounts business, and some recovery of market share. But I think it would need to be a much fuller recovery of that market that's gone to get back up towards that sort of 7.5. Okay, next question I think is probably one for you, Adam. I'm just looking at the
yeah, sure. Yeah. Next question is about clarification on timing of the profit improvements from the transformation plan, noting that a 15 million pound profit improvement would mean no profits for over 3 years. Now, I think the key thing to note here is if you reflect back on that slide that Chris talked about the medium-term profit outlook. There's kind of 3 drivers of that. There's the implementation of the existing strategic initiatives, so growing into the larger customers, growing in trade counters, and particularly the maturity profile of those trade counters. That middle box then was the 15 million pounds attributed to the transformation plan, and on the right-hand side, market recovery, and reflecting on the fact that the market is now over 25% down on where it was in 2019. So we expect some significant market recovery to come. So the 15 million pounds is just the middle box. So of the 3 drivers of profit over the medium to long term, just the middle bit of that. And as we talked about, 15 million pounds is a run rate coming out of the 2-year transformation program. So by September 26, at a run rate of about 15 million pounds. There's a follow-on question in there, which is about the 25 million of one-off costs that I can see, and it asks when. So how much of those one-off cash costs will hit the P&L account over this period? So that 25 million pounds of one-off cash costs are all in this 2-year window over the next 2 years, but they'll all be non-underlying. So they won't hit the underlying P&L. They're all non-underlying exceptional costs. in the same way that any profit on disposal of properties, as we showed in half one, that was also a non-underlying income that was an exceptional income. So that those costs will be in the middle column of our P&L as non-underlying items. And then there's a linked question, I think, on here, which is around how many employees are required to be made redundant to produce the £15 million of profit improvement. Well, the key thing here is that the transformation plan and the £15 million is a hybrid around with quite some significant reinvestment. So the headcount impact is actually pretty modest. If you look at the sales transformation, for example, we've reinvested quite a significant chunk of that of those savings in making smaller territories for each of our sales teams. So we could have had a higher headcount reduction, left the size of territories the size that they were, but we've shrunk those territories, reinvesting those savings to allow our sales team to spend more time with customers. So headcount impact is relatively modest from this. Okay. The next one might be for you, Chris.
Yeah, thanks, Adam. So the question reads that every business before that's consolidated and rationalised trade brands has lost turnover and market share. So why do you assume an increase in market share, and what increase in turnover are you assuming in your projections? So I think the answer to that question is that we're not necessarily rationalising our trade brands as such. These are multiple, I suppose, overlaying customer visits, trying to sell sometimes the same product to the same customers in the same way. So what we're trying to do is focus on that customer simplicity. What do customers want? What do they need? What are they asking for? And what they're asking for is that I just want everything in one go. I don't want to see 3 or 4 of your salespeople to get access to your products. I just want simplicity. I haven't got a lot of time. And therefore, what we are doing is allowing our salespeople more time. We're not taking out so many salespeople that they're spending just the same amount of time as they are now traveling. They're going to have more time to spend with customers, and they're going to have access to the broadest range of products that we can offer. So this is about leaving salespeople in the business in order to meet customer needs, and therefore not lose products from the portfolio, not lose customer contacts. So the salespeople are keeping most of the sales people, and the customers will have the same relationship they had before, but they'll just be on a much smaller patch. So that's why I think it's a bit different, perhaps, to what we've had before. And as a result of having more time and more customer focus, we think there's a good chance that we may increase our share of sales as a result. But that isn't a big feature of our plans. This is just about making ourselves simpler to do business with and giving customers access to products in one go. There's just just before I pass over to you, Adam, on the gross margin one, there's another couple of questions that have come in where we talk about Domus. So you never mention Domus nowadays. What percentage of our annual loss could be attributed to Domus? So Domus is a small business, and for those who don't know, it's a ceramic and engineered wood business that focuses on specified projects, typically in Greater London area, but it sort of represents 2 or 3% of the group turnover, so a pretty small business, and it doesn't actually contribute anything to the loss. It's not a material item of the group, and it isn't got a significant loss for us to report on. So that's an easy one for us to knock off. So Adam, perhaps you want to pick up the gross margin for.
Yeah, sure. So the question that we've had is gross margin fell by 86 basis points in the first half. How much of this was due to a fall in purchase rebates? So from a gross margin percent perspective, actually, purchase rebates are pretty flat year on year. So that's not a factor. Pound margin is a factor because we've held the rebates as a percentage of sales pretty much flat year on year, so it doesn't impact on the gross margin percent, but it does impact on the pound gross profit number. Just as revenue drops or cost of sales drops, then the rebate number does, but it's not a margin percent factor year on year in the first half of the year. There's another one that's kind of related, which maybe I'll take now actually, which is around transformation plan creates the need for stock write-downs. Why is this? So There's a couple of factors here. So one is from a network optimization point of view, we're obviously moving, we've got to create space to move operations around. We're obviously moving Ipswich operations into Rayleigh. Ipswich is 190,000 square foot. Rayleigh is about 125,000 square foot. In the mix of all that, there'll be some stock write-downs where there's maybe some slower moving items that we've held on to for 2 or 3 years that we will just accelerate the write-off through accelerated clearance. Then also, as part of the simplification from the of the back office operations that Chris talked about, we're centralizing the buying function, which is creating one product list, centralizing the buying and ranging functions. And as a result of this, we anticipate there may be some ranges that perhaps we bought 3 years ago that will be surplus to requirements. So it's those that are written down as a result of the transformation plan.
Thank you. And then the last question. So we talk about putting customer first and aligning the sales approach. Can you share with us how customers are responding to that, and how our sales team are also responding to the changes we put in place? So when I made these announcements, someone asked me what were my concerns, what were the things that were going to worry me. And I think the two things, as I saw, the most important features of having a successful change like this, one is the response of customers, and secondly, it's the response of your own people and your sales team. And your sales team are incredibly important in that relationship with the customer. So to communicate that effectively, if I cover our sales team first, so we pulled them all together. We talked about moving to a single business and a single brand, and as you can imagine, there was a bit of a surprise response, particularly when some of them felt like they'd been competing with this particular brand for some time. But we explained the features, the benefits to them as individuals of reduced time in cars, more time with customers, access to broader product ranges than they've had before. And also, even though we'd eliminated much of the internal competition, not having to worry about being the first Headlam person through the door to show a new range to a customer, fearful that one of the other businesses would get there ahead of them. That sort of simplification and having customers being able to deal with them solely as part of the group was really persuasive, and has really given them a positive view on this. So we've had no fallouts, no one leaving us as a result of that communication. And then secondly, for customers, as I said, we are migrating through our customers at the moment, and we've seen a significant level of customers now trading through the new way of working. And again, I would say the overriding response is, I can't believe it's taken you this long to do it. It's that kind of a feeling and that kind of response. And say at the Harrogate Flooring Show, which was last month, we showed up as a sort of Team Mercado, if you like, with a number of sites and a number of stands all commonly branded. And again, the overwhelming response for all the customers that I talked to was, about time. What does it mean for me, really? It was kind of like, well, who's my salesperson going to be? And that was about it. So a very positive response, no negatives that we've seen so far. So a bit of surprise from the industry, I'd say, but probably an overwhelming, I can't believe it's taken you this long to do it.
Perfect. That's great, Chris. Adam, thank you for addressing those questions for investors today. And of course, the company can review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. But before we redirect investors to provide you with their feedback, which is particularly important to the company, Chris, could I please ask you for a few closing comments?
Yeah, of course. Look, as I said earlier, it is a tough market out there, and that's evidenced by some of these businesses going into administration. So, these changes we've announced, important, needed. I feel the response from customers and our teams has been really empowering. So, it's important that we get this stuff done now, so that we're ready to be in an efficient place for when the market does recover at some point next year. So, yeah, it's going to be a tough period, and it's going to be into next year, but I feel confident that we're going to have a better quality business that comes out of it as a result. So yeah, I look forward to a much stronger kind of medium-term outlook. And thanks for joining the call today.
Fantastic, Chris, Adam. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of HEADLAM Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.